Hey, welcome back. It's Nolan Mathias, and today we are discussing our favorite mortgage, what we consider to be the best mortgage in Canada. And certainly it is the most flexible mortgage in Canada. But before I tell you what that mortgage is, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. It does me an absolute huge favor. So what is it? What is the best mortgage in Canada as far as we're concerned? Well, it is the one that my wife and I personally use. This is the exact mortgage that we have on all of our properties, and it is the Scotia Step, otherwise known as the Scotia Total Equity Plan. And the reason why we love the Scotia Total Equity Plan is because of its flexibility. In fact, it is one of the most flexible mortgages in the industry. And the reason why it is so flexible is because it is not registered against your title as a normal mortgage like most mortgages are. No, it's registered as what's called a collateral charge. And what a collateral charge does is allows the bank to register against your title a global limit. So let's say that you are getting a property for $500,000 and you're going to get a $400,000 mortgage on it. Well, rather than having a $400,000 mortgage that as the mortgage is paid off becomes less and less in value over a 25-year amortization, what a collateral mortgage does is it allows you to have a $400,000 charge against your property that remains at $400,000. What that does is it allows the bank to put multiple products underneath that collateral charge. So you can do really cool things like split up your mortgage between fixed and variable, or add a line of credit, or add a business loan or a car loan or a personal line of credit to your property. And what that allows you to do is it allows you to have more flexibility in how you borrow. And this isn't a product that is only suitable for conventional borrowers, it's also suitable for insured borrowers. And how an insured borrower might use it is to split up their mortgage between up to 3 products. So let's say you're putting less than 20% down, you're buying your first home, and you're unsure about fixed rates versus variable rates. You know that variable rates are better because you've watched our videos, and you also know that taking a fixed rate with a big bank is something that could end up costing you a big penalty, and you go, well, I'm not 100% comfortable with a variable rate, but what I want to do is I want to dip my toes and test the waters. And so what I want to do is I'm going to split up my mortgage between a fixed and a variable. So what you decide to do is take a 5-year fix for 50% of your mortgage and a 5-year variable for 50%. And you can pay them down as you see fit. So let's say you want to pay down the fixed rate faster or you want to pay down the variable rate faster. You can apply your extra money from your prepayment privileges to whichever one you like. So massive amount of flexibility. And in addition to that, you can go even further and you could add a third mortgage. So let's say you want to add a 2-year fix to it because that is a product that is really well priced at the time. Well, you have that option as well. You can go up to 3 products if you have an insured mortgage. Now, what about for conventional borrowers? What if you are somebody who's putting more than 20% down? Well, this is where it gets really interesting. This is the type of mortgage that allows you to turn your mortgage into a tax-deductible vehicle for investments. And let me give you an example of how we use it. So our Scotia Step mortgage has a variable rate mortgage with a HELOC or a home equity line of credit attached to it. And that line of credit has what's called an automatic limit increase. So as we pay down our variable rate mortgage, more money becomes available to our line of credit. So if I pay down $100,000 on my mortgage, I get $100,000 in an available line of credit. And then what I can do is I can take that line of credit and I can go and start using it to purchase real estate. Or I can do what's called the Smith maneuver and start using it to purchase investments. And as I do that, the money that I'm using to invest becomes tax deductible. So it becomes a really amazing product to build wealth. And if I don't want to use it for investments, it also gives me some peace of mind if I decide to use it to accelerate my payment of my mortgage. Because if you go back and you look at a video, and I'll post it right up here, it was called Our Big Mortgage Mistake. Back when we got our first mortgage as a couple, my wife and I, we made the mistake of trying to pay it down way too aggressively. And we were in a mortgage where we weren't able to draw the funds back out. And subsequently, we put all of our money into the mortgage, got completely cash poor. And when we needed to get out of that mortgage or we needed the money back to pay our bills, it became a massive problem, one where I had to actually go to my parents in order to ask them to loan us some money. What the Scotia Step allows us to do, especially if we have that automatic limit increase on our line of credit, is it allows us to go ahead and aggressively pay off our mortgage as fast as we see fit using our prepayment privileges. But it also allows us to be able to re-access all the money that we put into the property via a line of credit if we need it. So it creates a large amount of safety and a large amount of certainty if we want to try to pay that mortgage off faster. Now, how do you go and get a Scotia Step mortgage set up? Well, you could go to your bank directly. You could go to Scotiabank directly. But if you've been watching this channel, you know better than that. You know that you want to have somebody there to advocate on your behalf. And more specifically, you want to have a brokerage like Mortgage 360 who understands these products and knows that they can get them set up properly for you. Because here's the deal. There are other banks out there who offer similar products that are competitive to the Scotia Step. However, the one thing that the Scotia Step has that those lenders don't is the ability to have a broker advocate on your behalf, which means that when you go to get a Scotia Step mortgage and you're using a broker, you don't have to worry about negotiating because you're going to get whatever the floor rate at Scotiabank is at the time. You know that if you're going to get a variable portion and a fixed portion and a HELOC, that you're going to get competitive rates. Now, if you're to go into Scotiabank directly, you might get those competitive rates, you might not. It depends on who you talk to and your borrowing profile. But I can tell you unequivocally is if you are going to a competitor of Scotiabank and you're asking them for this type of product, they're going to say, hey, listen, this is a specialized product that requires you to pay more for it, which just simply isn't true. And then you've got to do that customer to banker dance of trying to negotiate a lower rate and trying to get them to at least be competitive, which can be completely avoided by going to a mortgage broker and dealing with Scotiabank directly. So along with the flexibility of the product, having the flexibility of a mortgage broker to help you through the process is huge when it comes to the Scotia Step Mortgage. And the brokers that we know that know this product really well, they know how to use it to build a real estate investment portfolio. They know how to use it for things like the Smith maneuver. They know how to use it to build wealth. And that's what you're looking for when you're getting a Scotia Step, is a vehicle that will allow you to build wealth beyond what a normal mortgage can do. Now, do I recommend this type of mortgage for everybody? Well, the answer to that is no, not necessarily. If we've got a client that is absolutely a 5-year fixed borrower, does not want to even entertain a variable rate, then we're probably going to tell them to go to a lender like First National or MCAP that has lower 5-year fixed penalties. But if we've got somebody who wants to test the waters of a variable, this is certainly the mortgage for them. If they've got more than 20% equity and they want to pay down their mortgage quicker or they want to invest, this is absolutely the mortgage for them. In fact, there's no other mortgage in my mind that is better. And most certainly, if it's the type of person who runs their own business, this is absolutely 100% the type of mortgage they should have, because people who run their own businesses often have the ability to pay off big chunks of their mortgage, but they also often have the need to pull equity out of their home, which makes this the perfect type of mortgage for them, because once they've got it set up, it's set it and forget it. And you've always got the ability to go back and pull out the equity as you need it. Now, for people who are spenders, people who are going to just throw money away, do we want to set them up with an automatic increasing limit on a line of credit? No, it can be very dangerous. But for people who can manage their finances and people who manage them well and manage debt well, this is absolutely, without a doubt, the best mortgage in Canada. So if you found this information useful, if you liked what you saw, if you think you might like a Scotia Step, hit that subscribe button, hit that notification bell. The comments are always open for questions. What are your questions about Scotia Step? We'll answer them down below if we didn't answer them in this video. And please do me that favor. It really is a huge favor. Hit that like button so more people like you can see this video, and we'll see you on the very next one. Cheers.